Hello, Brent Bruce here at Network Funding, giving you some information today about my favorite loan product, which is the VA home loan. I want to talk to you about some underwriting qualifications that you may not be familiar with and may have actually even caused one of your transactions to fall out of escrow. You might be wondering why that happened. So first of all, I want to make sure that you know that the VA home loan is currently the best performing home loan in the United States. Lowest foreclosure rates of any loan product, even though it is a zero down loan program. Commonly, people don't put any money down on the home, but yet they're having the smallest amount of walk away and foreclosure of any loan product. So it kind of dispels that thought that there has to be skin in the game in order for someone to want to stay in their house and be willing to make the payments even when times get tough. So this is just a very good loan product, and one of the reasons may be because we have what's called a residual income requirement. So this is an underwriting factor, a qualification that is not common in any other loan product. It's not something we look at with FHA, not something we look at with standard conventional. What this is we're taking a look at our client and we're taking all of the expenses that they might have, including their income taxes and maintenance on their home, and taking that number into account and finding out how much money does this person have left, and do we feel that there's enough money there in the residual for them to be able to support, maybe when something happens that they would normally miss a payment, but they have that residual income to be able to weather any small storms. Now what the VA has done is they've come up with factors, numbers that they feel fit for different regions and different loan amounts. Okay, so the first thing is we break it up. Is the loan under $80,000 or is the loan over $80,000? Now normally the home loan is going to be over $80,000, especially in the Southern California market where I am. So then we take the over 80,000 factor and we determine how many people live in this house. So for instance, if it's only one person, just a single individual that is doing a VA home loan, lives in, say, Southern California, they are going to need to have a residual income of at least $491. Now a family of 5 goes up to $1,158, and it can go up from there, which is about $80 per person over 5. So that we have to calculate how much the proper residual income is, but then we're going to make sure that that person has enough money. So what we would do is we take, first of all, their gross income. So we take the gross income, we take that and we'll go to a website or some other location that has been determined by our underwriters as to where we're going to calculate proper income tax deductions. So we're looking at everything. We're looking at Social Security, state income tax, federal income tax, the Medicaid withdrawals, all of those different numbers that we have to take out. So if somebody has, for instance, a $5,000 a month gross income, we might now have just taken out, say, $1,200, $1,300, $1,400 for taxes. We're also going to take out the mortgage payment, including the taxes and insurance and any mortgage insurance or homeowners association dues on that property, as well as the standard deductions that we would have, such as credit card payments, car loans, school loans, any other installment loans or loans that are showing up on the credit report. We also have to consider any child support or spousal support, maintenance, anything like that. So we're taking out all of the expenses. We're also going to do a factor for maintenance. So we have to take a property, say it's a 3,000 square foot property, we're going to take usually 14 cents a square foot, and we're going to take that out of the residual income as well. So it's a more holistic calculation, a more realistic calculation of how much money a person actually has left. After all those numbers are added together, we subtract that from the income, and we're making sure that there's enough residual income to qualify that client. Now I think this is an extra layer of qualification, quite honestly, that is a very good addition. It helps people to make sure they're not biting off more than they can chew. There are instances where we're able to qualify someone through the automated underwriting engine for very high standard debt ratios, maybe even excess of 50% debt ratio. Well, if they don't have any money left after that, they're going to be in a position where if anything goes wrong, any storm comes their way, they could end up missing mortgage payments. So I wanted to make sure to talk to you about the residual income requirements. If you want further information or more training, please respond to this video or give me a call. I'd be happy to go over it with you. I could probably send you the charts that we use to calculate those numbers if you do want to get more into it. but you need to be asking your loan officer or qualification people when it comes to you taking a client out to find a house and you know they're using VA, do they pass the residual income requirements? And if the person you're talking to doesn't know what you're talking about, that should be a big red flag. If you have any other questions, please let me know. I'm happy to help. Brent Bruce at Network Funding. Make it a great day.